Yes, lovers of financial management, welcome to our class. Today we are winding up on the topic of business valuation. Therefore, I welcome you, sit, enjoy, and share with your friends these particular videos. Actually, if you want to reach us well, you can reach us on YouTube, that is CPA Makan under SIPS College. So welcome, like, subscribe, and share with your colleague. And therefore, before I wind up this topic on business valuation, let me just share something few small here. Uh, we have this textbook here called Financial Management and Fundamentals of Finance. This is a CPA textbook that is mainly very important, covers financial management, basically prepared based on the CASNEP syllabus. And therefore you can get this book at a very affordable price at 1,500, or you can go visit to any of the National Library, specifically National Library here in town Nairobi. You'll be able to find this book there. Go through, find the content that is inside this particular book. It will inspire you to be a very good financial manager in any organization, and it can also inspire you to be a lecturer in any of the colleges. Therefore, I advise that you buy this particular book called Financial Management and Fundamentals of Finance, and it's purely made was actually authored or written by CPA Makan, and CPA Makan is the one speaking before you, and therefore this is a very motivative book and very inspiring book. Therefore, for lovers of financial management, I advise you to get each of this particular book and use it for your revision. Thank you so much. Welcome to our class. Today we want to discuss about some few methods that are mainly used for valuation of businesses. So we have discussed about several methods of valuing businesses, and we have discussed about what need to be valued in the businesses. And today we want to discuss about two elements that are very important when it comes to valuation of business. That is to say, that is what we call relative measures, use of relative measures. This is EVA and MVA. So EVA and MVA is a very common method mainly used to value businesses in a given organization. And therefore, and it's also a very common method that is mainly asked by CASNEP syllabus for students to be able to explain what is the meaning of the word EVA and what is the meaning of the word MVA. Then you will also be asked to do some computation. Therefore, before I begin, let me just begin with the first one element, that is EVA. EVA stands for economic value added. So economic value added is one of the methods used to measure the value of a given business or a given security. This particular EVA here states that for us to do a good valuation, we have to ensure that we carry on the cost of capital. That is to say, the rate in which the capital is attracting the cost to the organization. We call required return. So in most of the businesses, people actually value business based on the profits. They say revenue minus cost to get the profits there. This profit is not enough because it ignores what they call cost of capital. That is required return on the investment. So therefore, when we use now economic value added method, it caters for the investment cost. That is to say, required rate of return of the investor. So for that case, out of the profits that we have already computed, we need to adjust it to accommodate the cost of what? Investment. So this cost of investment is an element that is very important when it comes to valuation of a business. So therefore, if we don't include the cost of capital, the cost we incur to bring in the funds into the organization, then it means that the net profit reported by that particular organization is overstated. And therefore, the correct position or the correct market value of that particular entity is actually compromised. And for us to get the correct figure, we need to use what they call economic value addition. So what is economic value added? Economic value added is a method or is an income in which a company has earned more than required rate of return. So if the company has earned an income that is more than required rate of return, that net difference is what they call EVA. So EVA is an income to an entity where it is above the net required rate of return. Therefore, it means that for us to calculate EVA, it should be EVA is calculated by profit net operating profit after tax. You subtract the cost of capital, and therefore net operating profit after tax is prepared based on the accounting concept. This accounting concept here has just given us the value of the asset, the value of the organization. But this value of the organization is not accurate because it has not captured in the cost of investment. And therefore, if we subtract the cost of investment from the net operating profit, then the answer we are getting is what they call what? EVA. And this cost of capital here, sometimes we call it cost of investment. Cost of investment. Correct? If we don't want to use the word cost of investment, we can also use the word capital employed. Capital employed. And I want us to understand the meaning of the word capital employed. Capital employed is one of the terms that is mainly used when we are doing business analysis. That is under ratios. If you go to a topic called capital analysis, you will find this term capital employed. Capital employed here means you are taking all the equity. You take equity of the entity, then you add debts. And these particular debts you are referring to are long-term. So, long-term debts. So, therefore, if you take all the equity of that particular entity plus the long-term debts, the answer we get is capital employed. So, this capital employed here is what is mainly used to value the asset. It is like a cost in this particular case. So this cost here is what amounting to what they call cost of capital. And for that case, for us to calculate this capital here, we need to remember the accounting equation. Accounting equation says you take the total assets should be equals to capital plus liability. So therefore, for us to get the capital employed also here, or just capital here, or an investment, we have to use this formula. Like for example, in most of the questions you are going to do, these elements are very important. Assets, capital, and liability. Because the three will form what they call accounting equation. And when you look at it keenly, you will find that there is what they call cost of capital in this particular element. And therefore, this what we call EVA is net operating profit less cost of capital. This cost of capital in most cases is given as a percentage. So this one is mainly given as a percentage. In this case, we are going to know what is weighted average cost of capital. Weighted average cost of capital is also one of the averages that is mainly used to determine the cost incurred in the investment. Therefore, this particular work here is mainly analyzed under the topic of cost of capital and capital what? Structure. So therefore, this work is very important. The next video, we shall be discussing about cost of capital and capital structure, whereby we are supposed to know how to calculate the weighted average cost of capital. But at this particular time, we just want to know that this is a rate in which the investor is expecting returns from his or her investment. So therefore, this is acting like a cost of capital in terms of what? Rate. So we are going to use this one. But after this, we shall be having a video concerning the same. So therefore, because I've already explained what is the meaning of EVA by saying EVA, economic value added, is the income of an entity that is above the required return. Correct? So let's see an example. Examples are actually in our notes. I shall be sharing the link on how you can access the notes on this particular topic of business valuation. Question says, no part of ABC Limited is 10,000 shillings. No part is net operating profits. Total assets is 40,000 and the total liability is 15,000. Work is now weighted average cost of capital of 7.5%. Calculate EVA. So we now say yes, the formula is that Then we need to calculate EVA. In this case, we have been told no part is 10,000 and total assets 40,000 and liabilities 15,000. So this one is going to the equation of accounting equation. So what is missing here is capital. So in this case, we now say capital is given by assets minus liabilities. So in this case, assets, you have been given total assets as 40,000, then you less liabilities of 15,000. Your answer is 25,000. 25,000. Therefore, we now say EVA is given by no part is 10,000 from the equation minus cost of capital. We have been told it is 7.5% of 25,000. So therefore, this will give you 10,000. You minus 1875. Then your final answer is 8,125. So therefore, it means that the correct value of that particular entity is 8,125. Instead of saying the value of the asset is what? 10,000. So this 10,000 does not have the cost of capital. And therefore, for us to use the relative measures, we have to ensure that we capture the cost of investment. That is example 1. Example 2 is comprehensive one. It's a comprehensive question. So therefore, allow me to wrap the board so that we do this comprehensive question well. So in this case, we are saying for us to calculate EVA, students must be in a position to calculate or to remember 3 main elements. One is the net operating profit after tax, not net profit of not retained profits. Don't bring in the retained profit, because retained profits means you have already distributed what? Dividends. In this case, don't bring retained what? Dividends, retained profit. So therefore use profit after tax. So in this case, students must know how to prepare or how to adjust on the net operating profit. Number 2, students must be in a position to calculate cost of capital employed or investment. Capital employed is purely equity plus debts, or just say investments if given. So it depends on the question. If the question is analyzing issues to do with the debts, long-term debts and the short-term debts, automatically remove the short-term debts and bring in the long-term debts. So let's see the question. And also what you are supposed to know is how to calculate the weighted average cost of capital, which is very important to determine the value on the cost. So let's see the question. There is a question there given and labeled question number 24. It says, the following information relates to Jasho Limited. So we have been given 2 years, that is 20x3 and 20x4. Revenue given there for the 2 periods. Pre-tax accounting profits, taxation profits, profit after tax, then dividends, then retained earnings. So when you look at this question here, no part is not retained earnings, but profit after tax. Then we have statement of financial position extract. We have the non-current assets figures given. Then we have the current assets also figures given. Then we move on. We have the financed by. This financed by here means equity. Equity is made up of retained earnings plus ordinary share capital plus preference share capital. So if you have those one, then you'll be able to calculate this particular point very well. Now, but for this one, we have been told that financed by, meaning the share capital here in this case is 195, then 236, then medium and long-term bank loan. So when you add now these two, you get what you call capital employed. Capital employed is made up of retained earnings or equity, plus the debt. The debt, and which debt? Long-term debt. Then we have additional information. So this additional information means that this additional information given is going to affect our figures that we have already been given in the financial statements. So you have to know how these additional information are going to affect the figures in the financial statement. So let's see. A. Jasho Limited had non-capital leases valued at 10,000 in each year for 20x2 and 20x4. So in this case, we have non-capital leases. So this one, non-capital leases, will fall under capital employed. Therefore, it will increase the capital employed for the 2 periods. From which year? 20x2 to 20x4. B. Capital employed as per the year 20x2 financial statements was 223 million. That is now the for 20x2, but we are dealing with the 20x3 and the 20x4. So you have to understand why were you given 20x2. The balancing figure or the closing figure for 20x2 will be opening figure for the 20x3, and the closing figure for 20x3 is the opening figure for 20x4. That is the principle. So you are given this 20x2 so that you carry forward to the 20x3. Number C, the pre-tax cost of debt was estimated at 9% in the year 20x3 and 10% in the year 20x4. That is cost of debt. Then we have D. Joshua Limited cost of equity was estimated to be 15% in the year 20x3 and 17% in the year 20x4. This is cost of equity and cost of debt. What should come in your mind is now the weighted average cost of capital. So weighted average cost of capital is the average of all the sources of capital that has been incurred to bring in the finances into the organization. So the average of all the sources is what we call weighted average cost of capital. So we shall be discussing about the same topic. So in this case, we have to get the average of debt and that of the equity for us to get the correct figure there. Then E, the pre-tax accounting profit is obtained after deducting the economic depreciation of the company's non-current assets. This is also the depreciation used for tax purposes. So they are saying that the pre-profit, the profit that has already been shown in the income statement, is after deducting the accumulated depreciation. For that matter, when the tax authority came in, they agreed with the figure. So remember, I've analyzed the topic on accounting for taxation IAS 12 in our YouTube also. So if you want to know more about the taxation issue, go to our YouTube. That is CPM account under SIPS College. So I've analyzed this. So in this case, it says that if there is a disparity in terms of understanding between the accounting concept and the taxation concept. So some of the expenses are deductible according to accounting concept, but these deductible expenses are disallowable according to the taxation concept. But if the taxation concept and the accounting concept agree, then the figures are supposed to be treated as per the agreement. In this case, the tax authority and the accounting concept have agreed that the correct figure deducted as depreciation is correct. If not, this depreciation is not an expense, so it should be added back. F. The target capital structure for Joshua Limited is 60% equity and 40% equity. This is the composition. This is the composition of capital in the organization. That there was 60% out of the total capital, 60% for the equity and 40% debt. Continuation. The effective tax rate was 30% in both 20x3 and 20x4. H. Economic depreciation was 30 million in the year 20x3 and 35 million in the year 20x4. So they are giving us the amount of depreciation as per the additional information number E, whereby they agreed, the accounting concept and the tax authority agreed at 30 million for 20x3 and 35 million for 20x4. Other non-cash expenses was 10 million per year in both two years, that is 20x3 and 20x4. So these non-cash expenses, they were deducted from the revenue. Therefore, because they are non-cash expenses, we need to add back. So they are disallowable. So we'll add back to adjust the no part. Then interest expense was 4.4 million in the year 20x3 and 6 million in the year 20x4. So there is this interest expense actually deducted from the revenue. Unfortunately, this interest expense will attract what they call tax advantage. Tax advantage is treated as an expense. So therefore, this interest expense does not include purely the tax advantage. Therefore, we need to calculate this one to calculate the tax advantage from these figures. So therefore, tax advantage is always 1 minus the T. T means the corporate tax. In this case, the corporate tax is already given as 30%. So required, stating any assumptions made, estimate the EVA of Joshua Limited for both the year 20x3 and 20x4. So comment on the performance of Joshua Limited. So let's do some workings before we do computation. So workings here, I'm talking about we need to adjust our formula. First of all, let's adjust our no part. No part here, we have now 20x3 and 20x4. In this case now, we can say balance brought down, it is the profit, net profit after tax, not retained earnings. So retained profit after tax is 44 million for 20x3 and 55 million for 20x4. So it is the profit after tax, not retained what? Profit. Then this retained profit has a problem. The problem that is there is that there was interest expense which was deducted directly for these figures to be arrived at. So therefore there was no tax advantage. So therefore we need to add that tax advantage, and the tax advantage of net tax interest. Net tax interest. Net tax interest now is you take now the loan, which is for 20x3 it was given as 4 million. So you take 4 million, you multiply by 1 minus tax, which is 0.3, 30%. Then for 20x5 it was 6 million, you multiply by 1 minus 0.3. So therefore if you subtract this, it will give you 0.7. Here is also 0.7. So therefore 0.7 times 4, your answer you get is 2.8 million. Then 0.7 times 6, you get 4.2. 4.2. Okay, so we are adding back. This tax advantage was not captured. So therefore they only deducted the expenses directly. Another element that is affecting this one is what we call what? Non-cash expenses. Non-cash expenses were affecting which years? Non-cash expenses of 10 million for 20x3 and 20x4. So we add here 10 million and also 10 million. So therefore we have now adjusted our no part. So when you adjust no part carefully here, you get 56.8 million, and this one will get 69.2 million. So therefore in our formula we have this for the 2 years. Then we also calculate the capital employed. Capital employed. Capital employed for which years? 20x3 and 20x4. So we have 20x3 and 20x4. So we can now calculate the balance brought down. I've said capital employed is made up of equity plus long-term debts. So in this case, the balance brought forward is the balance opening for the current period. So therefore there was the capital employed as per the question additional information for 20x2 was 223. Therefore it is an opening balance, is balance brought down for 20x3. So 20x2, 20x3. So it gives you 223. The closing figure for 20x3 was 250. So it is the opening figure for 20x4, which is 250. On this note, it was affected by additional information number A. Jasho Limited had a non-capital leases valued at 10 million. So we have non-capital leases, 10 million. Correct. And capital 10 million. This will give you 233 million. This is what? 260 what? Million. So we have now the no part, and then we have the capital employed. There was also a problem with our weighted average cost of capital. So we can now say weighted average cost of capital is given by weight of equity times cost of equity plus weight of debt times cost of debt, but is affected by what? Tax. We shall be discussing this one under cost of capital, so don't worry about it. So this is the weight. In this question we have been told that 60% is equity, then 40% is debt. So where we have the weight, you put now the 60%. 60% here, 40% here. Cost of equity, you have already been given in additional information number C and D. So we are going to replace it now. Well, now in this case, we now calculate and say, okay, if that is the case, what is 20x3? For 20x3 now, your work will be, weight is 0.6 times the cost of equity for 20x3. Cost of equity for 20x3 is an additional information number E, 15%, 20x3. Multiply by 15% plus weight of debt, we have been told is 0, which is 40%, 0.9 times cost of equity. We have been for 20x3, cost of, not cost of equity, but cost of debt for 20x3 according to additional information C, it is 9%. So you multiply by 9%, but it's affected by what? Tax. So if you work this particular element properly, substitute this properly, your answer you will get is 11.52%. Then we go to 20x4. 20x4, our work will be 0.6 times cost of equity for 20x4 according to additional information number D. Cost of equity for 20x3 is 17%. So you multiply here by 17% plus 0.4 times the cost of debt for 20x4 is 10%. But it's affected by tax. So this, if you work it carefully with your calculator, you are supposed to get 13%. So therefore, this work we have calculated here will automatically affect the cost of capital. So therefore, I can now say EVA is given by no part minus cost of capital. In this case, it is capital cost of employed cost. So that is how you are supposed to calculate. Now we substitute now 20x3. It will be now no part for 20x3. No part for 20x3 is 56.8 million times, minus cost of equity. In this case, 20x3 we are found to be 11.52% times the cost. Capital employed. Capital employed for 20x3 is 233. 233. You get the answer. Then for 20x4, cost of no part is 69.2 minus 13% multiplied by cost of capital. Cost of capital is 260. Then you get your answer. So that is how you have been asked to calculate that particular element. So you can complete that. Now, this is how to calculate your EVA. We go to what we call MVA. That is market value added. Market value added. MVA. Market value added is also one of the concepts that is mainly used to value the assets of the organization. This concept here states that we are supposed to focus on the market share, market price of that particular shares. So therefore, in this case, it means that we are using external sources of information, while EVA is using what? Internal sources of information. Why? Because this one is found in the financial what? Statement. But this one is not found in the financial statement. This information is found in the market, stock market exchange. Therefore, in this case, we are calculating, or we want to find out the market value of shares in relation to the book value of the shares. So we are comparing the market value of the shares against the book value of the shares. Has it increased or decreased? If it has increased, it means that the company or the entity has increased in terms of value. So the value has increased. But if the book value is higher than the market value, it means that the company has lost what? Value. That is how to determine the market value of that particular entity. Therefore, we can just say, okay, For me to get the market value here, for this case, for me to get the market value, I have to get the market value of shares minus book value of shares. So you have to ensure that you get the market value of the shares, then you measure with the book value. So book value here means these are the figures shown on the financial statement. So we compare the two. So let's see an example that is given there. I've given one example. So let's see. Consider company XYZ whose shareholders' equity amounts to 750,000. The company owns 5,000 preference shares and 10,000 common shares outstanding. The word common shares there means ordinary shares. Then the present market value for the common shares is 12.5 shillings per share and 100 shillings per share for the preferred shares. When they say preferred shares, they're talking about preference shares. Then determine the MVA for this particular case. So therefore, we analyze one by one. Consider company XYZ whose shareholders' equity amounts to 750 equity. Therefore, that is book value. So you can now say book value is 750. This one is equity. And remember, equity is made up of ordinary shares plus preference shares plus retained earnings. So if you add these three, you get what they call equity. So what is missing is market value. So calculate the market value. Market value here, we take the market price of the shares now currently, you multiply by the number of shares present in the market or with that company. So we have the ordinary share capital. In this case, how many shares are there? 100,000, sorry. Then out of this one, the market price per ordinary share is 12 shillings, 12 and 50 cents. This gives you 1,250,000. Then we have also the preference shares value. How many preference shares are there? 5,000. How much per preference share market price? 100. This will give you how much? 500,000. So if you add now this, you get what you call market price is 1,750,000. So 1,750,000 is the market price. So therefore you can see the market price is higher than the book value. Therefore it means that the company is doing well. So therefore I can say the value of that particular element is 1,750,000. You minus 750,000. Your answer is 1 million. So there is a positive. Okay, so it means that the value of the company is 1 million. 1 million. Correct. I hope you are getting right. So let's move on. Now, I want to know whether you know how to value some of the companies in an organization, some of the companies in a given country. For example, we have the unit trust. How do we value the unit trust as a company? How do you value the unit trust as a company? Is very important. So let's see now valuation of unit trust. Valuation of unit trust. We have to understand first what is unit trust. When you talk about a trust is an organization, or it can be a trust. A trust is a company, or it can be a group of people who are actually controlling or managing assets on behalf of another person. This another person might be having some of the disabilities that cannot allow that person to hold or to own the assets. For instance, if there is a minor is a person below 18 years. So a minor has a will. There is a will that has been written by the parents or somebody else saying that that particular child needs to benefit from the assets. And because of the age, the child is not able to manage this. What will happen? Sorry. What will happen there is that these particular assets belonging to this particular minor will be transferred to a trustee. Okay? This trustee will now keep or maintain or control this particular asset until the beneficiary reaches the age in which he or she is able to manage the assets. So the trustee that is having money or benefits or any asset belonging to the beneficiary or minor need to be valued. And for us to value this particular element, we have to do the following. Now, for net asset valuation, we don't value this now, this unit trust. You have to know how many assets are there. Very simple. So you take the stock, you add bills that are available in the form of receivables, you add other securities, then you minus operating what? Expenses. Then from there you have to divide by the number of units. So stock is an asset, bills are assets, and then other securities are assets, then you less expenses. So when you subtract, then you divide by the number of units. That is the type. Now you get what you call the value of what? Net asset valuation, value of the trust. So let's see from the question. A fund has 500,000 units, this one here, that own 9 million in stock here and 1 million in cash. So they are here in cash. So there was no operating expenses. Question is calculate the NAV. So NAV here, we have now 9 million. Let me just say 9 million plus 1 million divided by 500,000 is the same as 0.5. This gives you 10 divided by 0.5 gives you what? 20 million. That is how to value the unit trust. Then we say now valuation of mutual funds. The question is, what is mutual funds? Mutual funds, when we talk about mutual funds, we are talking about pool of money from different people, pooled together and invested in stocks, debentures or bonds to generate what? Income. So this money that has been pulled from different people and being managed by a professional body is what they call what? Mutual funds. So this fund has been pulled together and invested in different what? Either in shares or in bonds or in debentures. So when you collect all together, put together and hand it over to the professional body, that is automatically will attract an interest. So therefore that money is called mutual what? Funds. So there is one fund that I know that is behaving like mutual fund, that is Muhasib Sacco. Muhasib Sacco is purely for professionals. So professionals are pulling their savings together and they are now investing in bonds, shares of the bonds and debentures of the company, and also relying on the loans being advanced to the to the shareholders. So the shareholders will be paying the interest, and also the government bonds and debentures will also earning what? In profits for that matter. So therefore it is like amount of money pulled from professionals put together and can be loaned out. Is what they call mutual funds. And how do you calculate this value of this particular mutual funds? We now say yes, for us to calculate this one, a NAV is calculated by cash plus other securities, you minus liabilities. All the liabilities, whether it is long term or short term. Then you divide by the number of shares. So let's see from the question. I have a question there which says a fund has assets of 70 million, liabilities of 30 million, and 1 million shares outstanding. Calculate the net asset value of the fund. So assets of 70 million, so you can see cash, those are assets. Then liabilities are there as 30 million. Then they are saying 1 million ordinary shares. So calculate that. So assets, you have been told 70 million minus 30 million liabilities. Then you divide by 1 million. This will give you 40 million. Divide by 1, you get what? 40 million. So that is the value of mutual funds. Now we go to valuation of private companies. Valuation of private valuation of private companies. Private companies need also to be valued. And in most cases, most of the private companies are mainly valued based on the income approach. So we have two methods in which the private companies can be valued. One is what you call income approach. When you talk about an income approach, it is just an accounting concept. This is purely a calculation of the use of profit, accounting profits. So when they say income approach is accounting profits, whereby you say you take now revenues minus all the costs. You get what you call profit or loss. So that is what you call income approach. There is another one called market approach. So when we talk about a market approach, we are actually focusing on the market price of the shares. Here we are talking about price of shares. So when we talk about price of shares here, we are comparing the price of the shares at the beginning of the period and the price of shares at the end of the period. If there is increase in terms of share price, then we say the company's shares have increased. For instance, you can say that at the end of the period, which is P1, you minus P0, which is the price of the shares at the beginning of the period, which can be maybe 20 minus 15, you get what? 5. So this 5 here is the increase in terms of value. So therefore 5 is the value of the share. So that's what we call market approach, and the income approach is purely accounting concept. So these are the methods mainly and practiced by all the entities in the country to do valuation of businesses. So therefore this one marks the end of the topic of business valuation. So next lesson will be about cost of capital and structure, whereby we are able to now know how to calculate the cost of capital and what are the components of the cost of capital structure. So that is the next lesson. Thank you so much for having your time, and thank you for trusting this particular channel. Invite your friend, share with your friend, and you'll be able to get this one. So reach me on 0735 346 777 for notes and also revision. Thank you so much and have a blessed time.